Good afternoon and welcome to everyone on the webcast, those dialing in via the telephone lines and via LinkedIn. Today we are sharing Nedbank Group's annual results to the 31st of December 2023. And after 20 years as either the CFO or CEO of Nedbank Group, this is the 40th and final time I have the privilege of presenting either interim or final results for Nedbank. The agenda of today's presentation, as shown on the left, we'll start with myself providing an overview of the group's performance in 2023, a reflection on the operating environment and the outcomes we achieved on our strategic growth drivers. I'll then hand over to Mfundo Nkuhlu, our Chief Operating Officer, who will provide an update on our strategy, including the development of our world-class technology platform, a journey that we have called the Managed Evolution that is nearly complete, and the positive impact that this is having on clients and operations. Mike Davis, our Chief Financial Officer, will follow Mfundo with a detailed analysis of the group's financial performance, and thereafter, as we usually do in year-end presentations, each of our frontline managing executives will cover the performance of their respective businesses. I will then return to close the presentation with the outlook for 2024, our targets, a reminder of the Chief Executive succession process, and make some concluding remarks. You will notice that some slides are marked additional info in the top right-hand corner, and these are insights for investors, and we will not speak directly to these today. So starting with the overview, I am pleased to report that in a more volatile and difficult operating environment than we had forecast, we have met all the 2023 targets that we announced as our post-COVID recovery targets in March 2021. Being diluted headline earnings per share, or DHEPS, above 25 Rand 65, return on equity, or ROE, above 15%, a cost-to-income ratio below 54%, as well as ranking number 1 on Net Promoter Score, or NPS. And our focus now shifts to our medium and long-term targets, and in particular, ongoing improvements in ROE. In 2023, the operating environment for us and our clients was volatile and difficult, as evident in weak South African GDP growth, record level electricity shortages, high interest rates, and elevated levels of inflation. While there is still forecast risk, it does seem that inflation is trending down, interest rates seem to have peaked, and electricity shortages improved in the second half of the year. Although at the same time, geopolitical risks across the globe pose ongoing risk, and 2024 is an election year in many countries, including South Africa. Delivering on our strategy is showing results, and in our presentation today, we will demonstrate how our world-class technology platform has become the foundation for the delivery of strong digital growth metrics, improved client experiences, market share gains in key areas, and ongoing productivity improvements. We've also maintained our leadership in renewable energy and ESG matters, which we know are important to all stakeholders. On the back of this strategic progress, we delivered a good operational performance, evidenced in pre-provisioning operating profit, or pre-prop, growth of 15%, a positive jaws ratio of 4%, and a cost-to-income ratio that improved to 53.9%. From a financial perspective, headline earnings increased by 11%, as revenues increased by 12% and expenses were well managed. This was partially offset by a 30% increase in the impairment charge, with a much better performance in the second half of the year, in particular in RBB collections. DHEPS increased by 14%, and ROE increased to 15.1%, both of these metrics benefiting from the 5 billion Rand capital optimization initiative that we concluded in the first half of the year. We also maintained very strong balance sheet metrics in respect of capital, liquidity, and expected credit loss coverage, which taken together with a 14% headline earnings per share growth enabled a very strong 15% growth in the full year dividend. Overall, after a more difficult H1, we delivered a better H2 outcome, particularly on RBB impairments and on closing deal flow in CIB. And as you will see in my closing slides, we have the foundations and momentum in place to enable delivery of our medium and long-term targets, albeit in a difficult and highly competitive operating environment. Reflecting now on the external operating environment in a little more detail. The global macroeconomic environment has been volatile and difficult, impacted by the ongoing conflicts in many parts of the world and high global inflation and resultant monetary policy tightening, all of which impact on the South African economy. In addition to this, the operating environment in South Africa was impacted by several South Africa-specific issues, including record high levels of electricity shortages or load shedding, logistical constraints, inflation that remained sticky, and as a result, higher than expected interest rate increases that continued into the first half of 2023. The slow progress made in addressing key issues of energy security, logistics, and crime and corruption, coupled with fiscal pressures and increasing geopolitical risk, have added to South Africa's country risk premium that manifests in the yield curve. As a result of all of these, economic outcomes in 2023 were weak, evident in the graphs on the slide, showing deteriorating levels of business confidence, a rise in bond yields, albeit with a slight improvement in the fourth quarter, a trend of continued bond and equity sales by foreigners, and a depreciation of the rand. Eskom only managed to maintain an electricity availability factor of 54.7% in 2023, down from 57.6% the year before. Unfortunately, as a result, this means that South Africans continue to become poorer, with real GDP growth below population growth in rand terms and even weaker in dollar terms. Higher levels of GDP growth are key to resolving many of the challenges I have just spoken about. The structural constraints preventing this from happening around energy supply, logistics, and crime and corruption are being addressed through the government-business partnership to accelerate progress on these vital issues. From an energy point of view, it is estimated that the impact of the current very high levels of load shedding is somewhere between 1 and 3% of GDP. Although slow, progress on resolving this energy constraint is evident, catalyzed by the legislative changes to enable increased levels of private sector energy generation. As a result, the private sector has made significant investments in renewable energy, as evidenced in the 6 gigawatts of registered renewable energy projects, with more still to come. Progress on the government renewable energy programs remains mixed, with the finalization of some projects in late 2023 and the termination of others. If planned progress continues, in the medium term, load shedding could possibly be curtailed to largely stages 1 and 2, but delivering on this will be contingent on several factors, including improvement in Eskom's production levels, addressing grid constraints, further developing independent power producer capacity, and ongoing momentum of private power generation. The financing opportunity for banks remains significant and is likely to provide a multi-year growth opportunity, as shown in our booklet slide. Unreliable rail and port services further burden the private sector, negatively affecting trade, disrupting supply chains, and eroding the country's international competitiveness. Here, estimates from National Treasury put this impact on up to 5% of SA's GDP. The establishment of the National Logistics Crisis Committee, the publication of the Freight Logistics Roadmap, and some progress on clearing port backlogs also represents slow but steady progress in this area. Regarding crime and corruption, there is still much to be done, and the FATF grey listing continues to be in effect, informed in large part by the limited success on state capture-related investigations and prosecutions. On the consumer front, the prevailing theme is increasing pressure that many consumers are under due to a combination of factors, including the weak economic growth, load shedding, high interest rates, and sustained high levels of inflation, all of which erode consumers' disposable income. The 125 basis points year-on-year increase in interest rates in 2023, and of course 475 basis points since 2021, has been steeper than expected and is similar to the extent of interest rate increases experienced during the global financial crisis. Pleasingly, interest rates now appear to have peaked and remained flat in the second half of 2023. Inflation receded from the 7.2% at the end of 2022 to 5.1% by the end of 2023, averaging 5.9% over the year. This downward trend came mainly from falling fuel prices, offsetting the impacts of a weaker rand. On the top right graph, you can see household savings have reduced as disposable income remains under pressure and consumers have had to absorb high levels of debt service costs. Debt service costs themselves continue to remain elevated, highlighting the strain on consumer financing has increased, and as a result, we have seen a slowdown in household credit growth into the second half of 2023. Turning now from the environment to strategy, our three strategic value drivers of growth, productivity, and risk and capital management are shown in the top part of this slide, and I will discuss our ongoing progress on each of these shortly. Mfundo Nkuklu will provide an update on the progress we have made on our strategic value unlocks. They are shown in the middle of the slide after I conclude. So starting with growth as our first strategic value driver. The graph on the left highlights how growth across net interest income, non-interest revenue, and interest-earning banking assets has picked up over the past few reporting periods. Growth continued to be supported by client-driven activity, with CIB recording 20 primary client wins, RBB growing main bank clients by 9%, and Nedbank Africa regions growing their client base by 4%. Pleasingly, all digital metrics continued to grow strongly, with app volumes, that's the key retail channel, up 18% year-on-year and up by more than 300% since 2019, while the retail cross-sell ratio improved to 1.96 times. External financial markets positively benefited assets under management, which increased by 14% to 448 billion rand, and markets revenue in our CIB business increased by 7%. The endowment benefit from higher interest rates remains favorable and supportive of strong net interest income growth, although from a bottom line point of view, this benefit was partially offset by increased impairments, as Mike Davis will outline later when he talks to our very deliberate strategy of managing the economic relationship between endowment and impairments through the cycle. From a productivity point of view, we continue to see the outcomes of our structural cost optimization efforts, together with some one-off benefits, contributing to a lower cost-to-income ratio, showing a pleasing improvement from 55.8% to 53.9%. The cost-related productivity improvements have been largely driven by the benefits from our technology platform that is now 95% complete, enabling clients to use more cost-effective digital products and services, as well as ongoing process improvements alongside headcount reduction, mainly through natural attrition, and real estate optimization, amongst others. Our managed evolution IT build to date has been delivered on time, on scope, and on budget. The group's intangible software assets on balance sheet peaked in 2020 at 9 billion rand and ended 2023 at 7.9 billion, while the related levels of IT cash flow spend, which peaked in 2017 at around 2.3 billion per annum, have subsequently reduced as we near completion of the managed evolution technology build. Lastly from me, our key risk and capital management metrics continue to reflect a fortress balance sheet, even after the completion of the 5 billion rand capital optimization initiative during the first half of the year that reduced CET1 by 70 basis points. So starting on the top left of the slide, under capital, our CET1 ratio at 13.5% remains well above the 12% top end of our board target range. And after the capital optimization initiative, we have still retained a 12 billion rand average surplus capital in the centre. On the bottom left, a final dividend of 10.22 rand per share was declared at a 57% payout ratio, with the final dividend up 18% on the 2022 final dividend. Liquidity metrics in the middle of the slide, such as the LCR and NSFR, remained very strong. And under credit, our credit loss ratio increased to 109 basis points, which, as we guided at interims, is above the 100 basis points top end of our through-the-cycle target range. But pleasingly, the credit loss ratio improved from 121 basis points in the first half to 96 basis points in the second half of the year. In particular, in RBB, while in CIB, we made excellent progress in resolving and de-risking Stage 3 loans that were in business rescue. Mike Davis and the cluster managing executives will discuss this in more detail later. The group's overall impairment coverage ratio increased to 3.62%, highlighting ongoing prudency in balance sheet provisioning in uncertain times. I will now hand over to Mfundo Nkuklu to talk to the progress we have made on our strategic value unlocks in general and our IT strategy that is a vital foundation for ongoing competitiveness in particular.
Thank you, Mike, and good afternoon, everyone. I'm pleased to report that the implementation of the group strategy is progressing well and yielding the anticipated financial benefits. In today's discussion, I will delve into how strategic execution is creating value and delivering results. Our strategy, which is enabled by a world-class technology platform and our employees as our most important asset, is delivered through 5 strategic value unlocks, these being digital leadership and digital experiences, market-leading client experiences, focusing on areas that create value, known as strategic portfolio tilt, driving efficient execution, including target operating model or TOM enhancements, and creating positive impacts, including delivery on the purpose of using our financial expertise to do good, while maintaining our leadership on environmental, social, and governance matters. The Managed Evolution Transformation Program has enabled us to build a modern, modular, and digital information technology stack. As Mike mentioned, we reached 95% build completion at the end of December 2023, and the program is aiming for full completion by the end of 2024, on time, on scope, and on budget. We are confident that we will not have an overrun in the investment spend on this program, as the intangible asset peaked on the balance sheet in 2020, and the annual IT cash flow spend peaked in 2017 and has been sustained at materially lower levels. The refactoring and modernization of our core banking systems and the digitization of the 2 remaining client onboarding and servicing journeys in home loans and vehicle finance will be completed in the second half of the year. Our focus now shifts to leveraging our new technology stack to simplify our product range by migrating existing accounts onto the new My Goals products, converging for scale across all segments, all channels, and all geographies, including harmonization of the Nedbank Africa region's IT systems, modernizing payments, automating processes end-to-end, leveraging data and generative AI for commercial advantage, and increasing our use of cloud computing and storage. Multiple benefits have been derived from our IT investments. For our clients, starting on the left, digital onboarding is now seamless and FICA compliant for both individual and juristic clients. Digital services have been automated, and today more than 200 retail client services and more than 400 juristic services are available on apps and electronic platforms, enabling our clients to self-service. Independent benchmarking by McKinsey, which we highlight on the additional information slide, shows that Nedbank ranks above local peers and above the average of global leaders on servicing features offered to clients on mobile. Digital sales penetration grew strongly from 2019, extending our advantage over local banks, with more work to be done to get closer to global benchmarks. Benefits for Nedbank are shown on the right of the slide. From a revenue perspective, we continue to unlock higher levels of cross-sale and increase the contribution from value-added services and beyond banking solutions such as AVU. From operational efficiency perspective, by adopting digital practices, we have managed since 2019 to reduce floor space and decrease headcount mainly through natural attrition, all contributing to the cumulative total of 4.2 billion rand of cost savings from both TOM 1 and TOM 2 to date. Lastly, Nedbank was ranked the 8th most valuable brand among South African companies, up from number 9 position in the prior year. Benefits in operational efficiencies are tracked in our target operating model or TOM program. At the end of 2023, the realized cumulative TOM 2 cost benefits increased to 2.2 billion rand. Our target of achieving 2.5 billion rand of benefits remains in place and is now expected to be met in the first half of 2024, following decisions to reconsider the timing of the implementation of some initiatives that are linked to revenue uplift, and a delay in some cost initiatives that we communicated at our interim results. The digitization of services in RBB and changing client behavior have enabled us to reduce and optimize the shape of our branch infrastructure through Project Imagine, as well as on our own campus sites, as shown on the right of the slide. Ongoing focus on extracting value from our technology investments has resulted in the initiation of TOM 2.1, which will focus on extracting additional benefits from maturing our data and analytics capabilities, the modernization of key processes, the implementation of generative AI strategies, and the modernization of payments. We'll provide an update on the progress and benefits of TOM 2.1 at the presentation of our 2024 interim results. From a lending and deposit-taking perspective, we have improved traction in gaining profitable market share in key areas while remaining selective in others in a difficult environment. Overall, total core loan market share remains steady year on year at 17.9% as measured through the Reserve Bank's latest December 2023 BA 900 data. Wholesale term loan market share increased to 16.4%, and we remain focused on unlocking growth opportunities relating to infrastructure and renewable energy in particular. In home loans, we increased our market share to 14.4%. In commercial property and vehicle finance, where we have large market share positions, we have been more selective in our credit granting. In unsecured lending, we have grown slower than market and deliberately given up market share given our assessment of the risk environment. From a retail deposit market share perspective, we were pleased with an increase in market share to 16.4%, while more work is required in growing share in retail transactional and commercial deposits. Through our fifth strategic value unlock, we focus on creating positive impacts and supporting sustainable socio-economic development as we deliver our purpose of using our financial expertise to do good. As shown on the graph, at the end of 2023, we have provided sustainable development goals-related finance to the value of 145 billion rand on our balance sheet. This now represents 16% of the group's gross loans and advances, up from 13% in 2021. We aim to increase this to around 20% by 2025. This financing is supported by some of the initiatives we highlight on the right of the slide, including 15 billion rand of sustainable finance across multiple SDGs, 28 billion rand for farmers and agriculture, 22 billion rand in support of SMEs, and 30 billion rand for renewable energy. Lastly, a few ESG highlights. Building on our leadership on environmental matters, as part of our results today, we disclose our first financed emission glide paths for thermal coal, oil and gas, and power generation in support of a reduction in greenhouse gas emissions as per our commitments and journey to net zero. Anel Bosman will share more details on this later. In 2023, we maintained our Level 1 broad-based Black economic empowerment status under the current financial sector charter, and we made good progress on diversity, equity, and inclusion. We recruited more than 2,800 youth employment service participants and almost 10,000 since inception, as we continue to make an impact on South African youth, their families, and communities. Employee satisfaction levels remained high, as evident in our 2023 Great Place to Work NPS score of 20, the second highest level since inception of our employee pulse surveys 5 years ago. Finally, from an ESG ratings perspective, we continue to rank at the top end of our local and global peer group across multiple ratings, as shown on the left-hand side of this slide. We are specifically pleased that our AAA MSCI rating has just again been affirmed, placing us in the top 5% of global banks. On that highlight, I hand over to Mike Davis to take us through the review of the group's financial performance.
Thank you, Mfundu, and good afternoon, everyone. I'm pleased to report that the group delivered a strong financial performance in 2023, with headline earnings up 11%, driven by strong revenue growth, partially offset by higher impairments. Diluted headline earnings per share increased by 14%, as the 5 billion rand capital optimization initiative resulted in the cancellation of just over 23 million shares. As highlighted by Mike, the operating environment has been challenging on the one hand, but as demonstrated by Mfundu, we've made good strides in implementing our strategy. These factors have had opposing impacts on the group's financial performance, as indicated on this slide. Reflecting on the key drivers of shareholder value creation, we are pleased to report that the group's ROE improved further to 15.1%, above our estimated cost of equity of 14.8% and above our 2023 target of 15%. A final dividend of 10.22 rand was declared, up 18%. Net asset value per share increased by 8%, notwithstanding the 5 billion rand share buyback we executed largely during the first half of the year. At these levels, this implies a price-to-book ratio of just below 1 times using the share price at the end of December. All of the group's profitability metrics improved, as seen in the solid headline earnings, DHEPS, and earnings per share growth, while pre-provisioning operating profit growth was strong at 15%, and total comprehensive income increased by 30%. Our NIM increased by 28 basis points to 4.21%, whilst our credit loss ratio increased by 20 basis points to 109 basis points, and total coverage remained prudent at 3.62%. Our balance sheet remained robust, with strong liquidity and capital positions well above board and regulatory requirements. Unpacking the primary drivers of the 11% growth in headline earnings, we have seen NII increase strongly by 14%, NIR by 6%, and associate income by 64%, supported by a very strong performance from ETI, all combining to produce revenue growth of 12%. Impairments increased by 30%, partially offsetting strong revenue growth, while expenses were well managed, increasing by 8%. Reflecting on the balance sheet, average gross banking advances increased by 7%. In RBB, the growth was solid as average banking advances grew by 7%, primarily driven by solid performances in our relationship businesses and gradual home loans market share gains. We have been deliberately cautious in the unsecured lending categories given elevated risk at this point in the cycle, and selective in credit origination and vehicle finance as we leverage our strong position with MFC. CIB's advances growth increased by 8%. The increase was driven by growth in our leverage and diversified finance business, as well as in growth in infrastructure, water, and telecoms and mining. The closure of various renewable energy transactions in Q4 will contribute to book growth this year. Growth in commercial property was moderate, supported by increased corporate activity. On the opposing side of the balance sheet, deposits increased by 5%, taking the loan-to-deposit ratio to 82%. Due to the expected reduction in interest rates, many clients termed out short-term cash into long-dated deposits. As a result, current and savings accounts, along with cash management deposits, decreased by 2% and 20% respectively. In contrast, call and term deposits increased by 6% and fixed deposits by 5%. NCDs increased by 7% and other deposits increased by 21%, driven primarily by growth in structured deposits to meet client-specific demand. Turning to the income statement, NII increased strongly by 14%, driven by growth in average interest-earning banking assets of 7% and a 28 basis point increase in the net interest margin. The increase in NIM was driven by a positive endowment impact of 38 basis points due to higher interest rates. This increase was partially offset by a negative asset mix impact due to slower growth in high-yielding assets such as unsecured loans, negative liability pricing due to a squeeze in deposit spreads, and negative asset pricing in part due to higher levels of competition for good quality assets, an improved risk profile in CIB, and higher levels of Stage 3 loan interest reversals. As Mike touched on earlier, our active approach to interest rate risk management continues to see us managing the group's endowment position to offset the impact of changes in impairments through interest rate cycles. In 2023, the incremental endowment benefit from higher interest rates continued to offset incremental increases in impairments. This net benefit is expected to remain largely intact in 2024 and 2025, as average interest rates in 2024 are likely to remain at similar levels to 2023, and in 2025, lower NII endowment due to lower interest rates is expected to more than be offset through lower impairments. NIR growth was 6% or 9% on a like-for-like basis excluding restatements. Key drivers include commission and fee income increasing by 5%, supported by main bank client growth, improved levels of cross-sell, as well as growth in value-added services. This growth was partially offset by a slowdown in client activity on the back of a more difficult macroeconomic environment. Trading income grew by 3%, reflecting good performances in debt securities and commodities. Insurance income declined by 16%, impacted by the deliberate slowdown in unsecured retail lending volumes, IFRS 17 changes, and new business strain relating to new insurance solutions. Excluding the IFRS reclassifications, insurance income would have been down 7%. Equity investment income declined by 6%, returning to more normalized levels when compared with a high 2022 base. And lastly, in other NIR, currency gains in ZIM on US dollar capital as a result of currency devaluation were partially offset by a higher net monetary loss. Turning to impairments, the group's impairment charge increased by 30% to 9.6 billion rand, which is an improvement from the 57% increase we reported in half one, after a better second half performance in RBB collections in particular. The growth was driven by a 29% higher impairment charge in RBB due to the pressure experienced in the consumer segment of our business due to the more difficult macroeconomic environment. Focused management interventions in the second half delivered benefits, including better collections and loan origination, with impairments down in the second half across all RBB products and segments, as shown in the booklet slide. CIB impairments increased by 17% year-on-year, higher in the second half than the first half, given the resolution of material Stage 3 loans. Good outcomes were reported in Wealth and Nedbank Africa regions. The group's central provision reduced to 150 million rand, and total overlays reduced to 1.1 billion rand, as risks have been incorporated in our underlying cluster IFRS impairment models. As a result of the higher impairment charge, the group's credit loss ratio or cost of risk increased to 109 basis points, above our through-the-cycle target range of 60 to 100 basis points, but in line with the guidance we provided. Pleasingly, in the second half, the credit loss ratio of 96 basis points was back within our through-the-cycle target range. The CIB credit loss ratio at 24 basis points was within the cluster's through-the-cycle target range, being slightly below the midpoint. The credit loss ratio in RBB increased to 194 basis points above the cluster's through-the-cycle target range, up from the 161 basis points reported in the prior period. Pleasingly, the second half credit loss ratio for RBB was back within range. Wealth reported a credit loss ratio of 12 basis points below its through-the-cycle target range, benefiting from the release of client-specific overlays as a result of better-than-expected recoveries, while the Nedbank Africa region's credit loss ratio of 100 basis points decreased slightly and remained within its through-the-cycle target range. The group's total expected credit loss coverage increased to an annual high of 3.62% as we remain adequately provided in a difficult macroeconomic environment. The group's Stage 1 coverage increased slightly to 0.66% and remained higher than pre-COVID levels. Stage 2 coverage decreased slightly to 6.8%, but also remained above pre-COVID levels. And Stage 3 coverage remained steady at 34.2% as RBB loans with higher coverage migrated from Stage 2 into Stage 3, and Stage 3 loans in CIB with lower coverage decreased as some counters cured or loans were written off. Shifting our focus to costs, expenses increased by 8%, reflecting good expense management as we maintained our focus on efficiencies and the benefits of digitization. The increase in salaries, wages, and other staff costs reflect the impacts of an average annual salary increase of 6.3% and higher costs to attract and retain key talent. This was partially offset by a 2% reduction in permanent employee numbers, largely through natural attrition. Computer processing costs increased by 8% and reflect the impact of the rand's devaluation related to foreign currency IT contracts, continued investment in digital solutions, and higher volumes. Discretionary spend has now reached normalized levels post-COVID, but costs of 107 million rand associated with increased levels of load shedding had to be absorbed. With respect to capital, our CET1 ratio decreased to 13.5%, having absorbed the 5 billion rand capital optimization, and the ratio remains well above our board-approved target range of 11 to 12%. The group remains capital generative, which offsets growth in RWA, primarily in credit growth, and supports paying dividends at the 57% payout ratio. Lastly, before I hand over to our managing execs, a quick overview from me of our cluster performance. The group's headline earnings growth was driven by solid performances across all our business clusters, as shown on the slide, with all of our clusters growing headline earnings and reporting ROEs above the group's cost of equity. With that, thank you. I will now hand over to Anel.
Thank you, Mike, and good afternoon. In a demanding operating environment, characterized by inflation, low economic growth, and unstable geopolitics, it is pleasing to note that CIB achieved good results, growing headline earnings by 6%, underpinned by solid revenue growth and optimized capital utilization, with return on equity improving to 18.9%. Net interest income increased by 7%, benefiting from average banking advances and deposits growing by 8% and 5% respectively. Net interest margin was maintained as endowment benefits were offset by lower credit margins as risk improved, increased pricing competition on good quality assets, and suspended interest on Stage 3 loans. Non-interest revenue is up 5%, driven by trading and commission and fees income. Markets revenue grew 7% as debt securities and commodity markets compensated for reduced foreign exchange client flows. Markets revenue includes fair value adjustments, where higher funding costs in the NII line were offset by fair value gains on several structures designated at fair value in the banking book. Commission and fees growth was supported by a strong performance in trade finance, benefiting from our investment in this business as a growth driver in Africa. Deal closure and lending towards the end of the year generated fee growth from a high 2022 base. Equity investment income and dividends received contracted 5% of a high base after growing 33% in 2022. The credit loss ratio rose marginally to 24 basis points, but remained below the midpoint of the through-the-cycle target range of 15 to 45 basis points, and I will unpack this further in the presentation. Despite inflationary cost pressures and a firm commitment to attract and retain top talent, expense increases have been controlled at 7%. Average banking advances grew 8% as client activity increased, particularly in the second half of 2023 across various sectors. The renewable energy transactions that closed last year will contribute to book growth this year. As noted, average banking advances shows positive growth, while actual banking advances are flat, impacted by short-term transactional facility repayments and the optimization of our liquidity position. However, actual term lending advances grew by 4%. Our deliberate and disciplined approach to business selection and capital efficiency resulted in total allocated capital declining by 1%. Looking at the credit risk in the book, prudent risk management contributed to a reasonable impairment outcome against a challenging backdrop, despite the impact from a single name exposure in the property finance business. Impairments rose by 17% to 939 million, and the credit loss ratio of 24 basis points is below the midpoint of the through-the-cycle target. The credit loss ratio, excluding the single large exposure in property finance, was mid-single digits and an excellent result on the rest of the lending book. Stage 3 loans have decreased to 16.9 billion due to some write-offs and the resolution of several material Stage 3 loans. We expect this number to decline significantly in 2024, resulting in an NPL ratio in CIB below 2.5%. The total coverage ratio decreased from 1.29 to 1.14% due to the restructuring and partial write-offs of the single property finance name and some Stage 3 exposures in investment banking and transactional services migrating to the performing book. Our Stage 2 exposures continue to decrease with a slightly higher coverage ratio, whereas our Stage 1 coverage ratio remains stable. With the significant increase in interest rates and the devaluation of currencies in Africa, it is important to highlight that CIB exposures are mostly to projects and commodities that generate foreign currency, are well structured and secured, with external insurance in place where required. Focusing on the commercial property sector, we saw some positive trends in the second half of the year, including stabilizing property values, an increase in the trading of properties, and corporate action. These indicate an improvement in sentiment and a level of confidence returning to the sector. Our property finance business continues to perform well, despite the negative impact of additional impairments raised on the sizable single-name counter mentioned earlier, elevating the credit loss ratio to 47 basis points. Our exposure has largely been resolved, with assets transferring to the purchasers post-conclusion of a business rescue process. Our portfolio continues to be collateralized by a high-quality and well-diversified security pool, and overall gearing remains low, with a portfolio to loan value ratio of 52%. Arrears on the 167 billion performing book remain low at 8 million. Nedbank, as a purpose-led organisation, is focused on creating positive impacts. One example is our exceptional support for renewable energy projects. Last year, we made significant progress in closing several renewable energy deals, both in government procurement programs and private power generation, with an anticipated future book growth of 18 billion rand. Our ability to be an innovative banking partner, to collaborate with our clients to implement impactful solutions and support them on their energy transition journeys, ensures that we maintain a strong pipeline of new mandates. Our commitment to supporting and enabling sustainable positive impacts is evidenced by our progress in our journey to net zero by 2050. In line with our energy policy published in 2021, we have finalized our initial sector glide paths, a good starting point for our roadmap to achieve our net zero commitments. As communicated last year, our emission reduction targets will initially focus on the emission related to our lending and investment activities in the upstream fossil fuel sector, particularly thermal coal, oil and gas, as well as power generation. We have used the International Energy Agency Net Zero Emissions 2030 targets in setting our glide paths, supported by our understanding of the just transition in an African context. We are targeting reductions of 47% for thermal coal and 26% for oil and gas by 2030, and will adopt a power generation cap of 188 grams of carbon dioxide equivalent per kilowatt hour. These will be calculated against our glide path financed emissions using 2022 as the base year. From a digital perspective, we continue to deliver a digital and client service capabilities to be the go-to transactional bank for South African businesses. In support of this, we completed the business reorganization changes under Tom 2. Key highlights include the launch of Voice of the Client to capture client sentiment, migrating more than 95% of global clients onto the Nedbank Business Hub, or NBH, and survey results showing that multi-banked clients feel the NBH experience surpasses competitors on critical measures, including channel convergence. We continue to drive innovation throughout our business with a specific focus on ensuring we deliver a warm digital experience and equip our employees and clients with the right digital and data capabilities to provide differentiated journeys, enhance cross-sell, and enable efficiency. Turning to the 2024 outlook, we look to maintain our momentum from the second half of 2023 on banking advances and have a robust pipeline across multiple sectors. We drive NIR growth by building diverse revenue streams through our transactional banking, trading, and advisory businesses. We will further diversify as we target opportunities in Africa with a focus on our areas of expertise. Commission and fees growth will benefit from the balance sheet activity I mentioned, as well as our transactional services focus. We monitor our portfolio proactively and focus on stressed counters as we maintain the credit loss ratio within the target range. We remain confident in delivering growth through leadership in various sectors, delivering great digital customer experience, and enhance our returns to increase our return on equity to above 19%, while reducing our cost-to-income ratio to lower than 44%. Thank you, and I will now hand over to you. Nico.
Thank you, Anel, and good afternoon, everyone. It gives me pleasure to announce that retail and business banking's headline earnings were up by 9% at an ROE of 16% for the full year 2023. The first 6 months of 2023 were marked by a difficult macroeconomic environment marred by slow GDP growth, high inflation, continued high interest rates, load shedding, and a worsened credit lending outlook. These challenges led to increased financial strain on our clients, resulting in elevated impairments in the first half of the year. However, during the second half, through dedicated focus and improved collections and recovery capabilities, we managed to claw back significantly in impairments, helping to support HE growth as mentioned. The main drivers of the growth was an 11% increase in revenue and well-managed expense growth at 7%, which was partially offset by a 29% increase in impairments. Growth in revenue was driven largely by strong NII growth of 14%, benefiting from endowment as well as advances growth. NIR grew by 7% off the back of a 9% increase in new clients, improved cross-sell, higher value-added services sales, and card interchange volumes. Impairment growth slowed down in the second half of 2023, increasing by only 3% compared to the increase of 60% reported in H1 2023. And in H2, the credit loss ratio moved back to within the through-the-cycle target range, whilst coverage was maintained. The expense increase of 7% was driven by judicious management of discretionary spend and ongoing optimization of operations through Projects Phoenix, Project Imagine, and other Target Operating Model 2 initiatives. Turning now to the segment franchises. In the increasingly competitive commercial and SME banking markets, our relationship businesses continue to perform well and strengthen their competitiveness. A few highlights of 2023 include commercial banking increasing its market share in the mid-corporate segment to 23%, continuing its positive momentum in its digital journey, with Nedbank Business Hub now achieving critical scale, and leveraging our industry CVPs, which have solidified competitive market share positions across all industries. Retail relationship banking maintained its market share across both the affluent and SME segments and continued to outperform, with good growth in clients stemming from our highly competitive offering, whilst client satisfaction matrix and cross-sell improved to all-time highs. Our beyond banking offering SimplyBiz remains a key differentiator through which we have provided over 47,000 business owners free beyond banking assistance in the form of advertising, coaching, access to relevant business support materials, and other strategic initiatives. There is an opportunity to further grow the client base in franchising, to focus on merchant acquisition, as well as leveraging our expansion of relationship services into underrepresented markets. The progress we're making in these businesses gives me confidence that we will not only be able to compete effectively against increasing levels of competition, but to continue to gain market share over the next few years. Turning to our consumer business, our digital innovation journey continues to improve through enhanced onboarding capabilities, as in the new My Goals suite of transactional products that can be opened in under 5 minutes on our digital channels. The current Greenbacks program is undergoing further changes and enhancements to create additional value for clients and improve the competitiveness of the program. The enhanced program will be launched in Q1 of 2024. Digitally active clients increased by 11% to 2.9 million, of which 2.3 million clients are now using the Nedbank Money app, increasing by 16% year-on-year. Digital platform sales increased to 55% of the overall sales activity mix, driven by a significant focus on digital marketing and sales funnel capabilities. Client satisfaction is seen as an increasingly strong differentiator for Nedbank, and we're therefore very pleased with the outcome of the Kantar NPS survey that ranked Nedbank number 1 amongst SA banks on Net Promoter Score for the second year in a row. Over and above the great experience we create on our digital platforms, we also continue to focus on investing in our people and our service excellence program, which is the backbone of the client experience we offer. Client satisfaction outcomes, along with digital capabilities, we believe are a key driver for client growth and retention, as well as improved level of cross-sell, which in turn led to the number of retail main bank clients increasing by 9% to 3.5 million. Cross-sell improving further to 1.96, also a reflection of the continued success of AI-enabled next best action strategies. We are also starting to see a strong correlation between main bank client growth and transactional NIR, which were both up by 9%, while from a deposit perspective, market share has stabilized and focus is now firmly on growing in household deposits. From a productivity perspective, through Project Phoenix, we are shifting our RBB organizational structure so that it is more client-centered. And through Project Imagine, we continue to optimize our branch infrastructure to deliver great client experiences, enhance sales, and improve productivity. It is pleasing to see that in the independent Finalta survey, where it is highlighted that the transition of our frontline business to an agile operating model is strongly underway, and the adoption of agile practices and values have positively impacted frontline salesforce productivity. Our continued focus on sales productivity has resulted in branch sales and service productivity improving by 24%. In addition, since 2014, we have achieved floor space reduction of more than 111,000 square meters. The above cost efficiencies enabled a lower cost-to-income ratio in the consumer business. Turning now to impairments, whilst the RBB credit loss ratio increased to 194 basis points, the trend improved from the 226 basis points in H1 of 2023 to 164 basis points in H2 2023, and the decline was evident across all products and segments. The key drivers of this improvement include a more stable macroeconomic environment in H2 2023, further credit policy tightening, particularly in unsecured lending, assisting our clients via tailored rehabilitation and support, optimized payment strategies and debit check mandate increases, particularly on MFC and card, enhanced collection strategies, and client-specific interventions supporting clients in commercial banking. These actions give me comfort that all else being equal, we should see an improving trend into 2024 and 2025. Lastly, reflecting on the progress we are making on growth, we continue to gear ourselves for ongoing competitiveness through the commercialization of growth vectors. The Ever Super Shop has been in market for 3.5 years and has signed up over 2.5 million clients, up by 26% year on year, and continues to grow exponentially. Value-added services increased by 29% across all products, including bill payments and digital vouchers, with over 1.5 million clients purchasing products across all of our channels. We have seen strong growth in commercial banking and MFC solar finance, with Home Loans Solar CVP and Ever Solar launched in H2 of 2023. On the insurance side, we are focusing on life, funeral, as well as personal lines. Within the township economy, we continue to innovate and leverage partnerships to co-create solutions with clients. We will soon be launching a CVP for informal traders, customized to their unique needs and behaviors. These growth vectors unlock alternative revenue generation opportunities and help pave the future for the bank. Turning now to prospects into 2024, we remain acutely aware of some of the macro challenges that clients will continue to face, and we remain highly focused on our collections and recovery capabilities, while at the same time maintaining our strategies to originate quality business. We expect continued momentum in advances and deposits growth, with NIM expected to decline as a result of ongoing product mix changes, as well as margin squeeze in client spreads. Our credit loss ratio is expected to move to within the top half of our through-the-cycle target range for the full year, but it will remain elevated in a difficult macroeconomic environment. Given the impact of seasonality, RBB's H1 CLR is likely to be higher than for H2. We aim to grow NIR by diversifying our revenue base and scale key growth vector strategies whilst we continue to optimize expenses and deliver positive jaws. Our client-centered growth strategy, as well as our execution plans, will also help us achieve these aspirations. Our long-term focus continues to be to reduce the RBB cost-to-income ratio and increase return on equity. Thank you, and I now hand over to my colleague Ayolanda.
Thank you, Tiko, and good afternoon, everyone. Starting with Nedbank Wealth's overall performance. Nedbank Wealth delivered a resilient financial performance with headline earnings up 6% to 1.2 billion rand and maintained a high return on equity of 26.8%, well above the group's cost of equity. NII increased by 42% to 1.7 billion rand, largely due to higher SA, US, UK and EU interest rates, which led to a widening of the NIM from 2.09 to 2.85%. NIR decreased by 4% to 2.9 billion rand, driven by lower traditional bancassurance volumes, new business strain from new MyCover solutions, and lower advice and investment fees in wealth management South Africa. This was partially offset by increased shareholder returns in insurance and higher AUM fees on the back of strong growth in AUM balances in asset management. Credit impairments increased due to lower client-specific overlay releases and higher portfolio provisioning in the wealth management SA business, as clients exhibited strain from the higher interest rate environment. Expenses increased by 10% due to ongoing investment in people, brand awareness, data and digital initiatives, as well as the adverse impact of the exchange rate and higher inflation internationally. Moving on to our divisional overviews and starting with Nedbank Insurance. Total insurance income includes the business that Nedbank Insurance writes on its own, as well as the business it collaborates with other clusters in the group. Declined by 16% to 1.4 billion rand due to lower traditional bancassurance volumes, particularly in the credit life, as RBB deliberately slowed personal loan growth in the current risk environment, the non-repeat of reserve releases in the prior year, and new business strain. This was offset by an improved non-life claims experience due to the base effects of the KZN floods in 2022. The life business generated value of new business of 372 million rand, and the non-life business grew gross written premiums by 15%. The 2022 financials have been restated to account for IFRS 17, as expenses and associated indirect tax related to insurance products are now recognized in NIR. The opportunity to cross-sell insurance products across the group is significant, with steady progress achieved through the collaboration between Nedbank Insurance and retail and business banking. Nedbank Insurance remained focused on growing penetration of the Nedbank client base through various channels with MyCover suite of products. The MyCover suite has shown good growth, achieving 41% increase in gross premiums earned, with MyCover Funeral up 16%, MyCover Life up 25%, and MyCover Personal Lines up 487%, albeit off a low base. Improving Nedbank Insurance digital proposition has been a key enabler to this growth, as you will see on the next slide. In insurance, 17 digital products are now live, up from 10 in 2022, and these can be found on 7 channels. The business launched the insurance widget and offers for you, increasing traffic and sales on the Nedbank Money app, and redesigned the insurance flow entry screen for enhanced client accessibility, resulting in improved user experience. Looking forward, the use of data and digital remains a key growth enabler to enabling client experiences. Nedbank Insurance remains committed to increasing penetration of its MyCover suite, which will be achieved through brand awareness and improved omnichannel offering, data-driven targeted campaigns, and collaboration across the group. Moving on to asset management. Nedgroup Investments celebrated 20 years of its best-of-breed fund range. The business has grown its unitized assets from 10 billion rand to over 400 billion rand over the past 2 decades, remains the third largest offshore manager for the 6th year in a row, and is the 6th largest South African manager according to the Q4 2023 ASISA stats. Overall, the Nedgroup Investments fund range performed well relative to peers, reporting a 14% increase in AUM on the back of improved market performance and strong net inflows, particularly in the cash and low-cost core ranges. Nedgroup Investments remains committed to delivering long-term investment performance, acting in the best interest of clients, and taking further steps in its journey of becoming a leader in responsible investing. And finally, looking at the wealth management businesses. Wealth management's headline earnings increased by 22% to 342 million rand, largely driven by an improvement in NII, and partially offset by higher credit impairments and a decrease in NIR due to lower advice fees. Average deposit balances in Wealth Management South Africa increased by 20% as clients favoured on-balance sheet investments in the rising interest rate environment. Average deposit balances in Wealth Management International decreased, and despite challenging investment market conditions, AUM has remained in line with expectations, with higher AUA levels in comparison to the prior year. As part of the group-led Target Operating Model 2.0 initiative, there has been good collaboration with retail and business banking and Wealth Management South Africa to increase the penetration of financial planning and advice into the Nedbank client base. The project to replace Wealth Management International's core wealth platform is still in early phases and is on track to be delivered in 2025. As we look ahead, our 2024 performance will be informed by a decrease in NII and a decline in the NIM as international interest rates are forecast to decline. An increase in NIR will be due to growth in the Nedbank Insurance MyCover suite, higher high net worth market share, and higher AUM through attracting net inflows. The credit loss ratio is expected to remain within our target range, and expenses are expected to grow marginally above inflation as we continue to invest in key initiatives and key enablers. Looking at the medium and long-term targets, Nedbank Wealth will continue to maintain a strong return on equity above the group's cost of equity. Thank you, and I will now hand over to Terence.
Thank you, Ayolanda, and good afternoon, everyone. Our strategy on the continent is to own, manage, and control banking operations in SADC and East Africa, and to give our clients access to a banking network in West and Central Africa through our 21% strategic investment in the Pan-African Banking Group, ETI, which has subsidiaries in 33 countries. In this context, the NAR business produced a strong set of results for the full year 2023, with headline earnings up 94%, generating returns of 25.2% and above the group's cost of equity. On the same metrics, if we excluded the reversal of the 175 million rand provision that Nedbank raised in 2022 in respect of ETI's Ghana sovereign bond exposure, HE is up 76%, generating an ROE of 22.9%. Our performance comes as a result of strong performance from the SADC operations, albeit off a low base, and the continued turnaround of ETI. On the right-hand side of the slide, we take a closer look at our segmental performance that contributed to the roughly 1.9 billion rands of HE for Africa regions. SADC operations HE is up 80% to 662 million, generating an ROE of 9.9%. While improving, it's still, however, well below the levels we would like it to be. Performance was largely driven by strong revenue growth, with NII up 25% and NIR up 17% respectively. And revenue growth was driven by widening margins, higher forex gains, and an increase in digital channel revenues. Expenses were up 7%, owing to tight and proactive cost management. Our impairments increased by 15%. However, the credit loss ratio of 100 basis points remains within our through the target range of 85 to 120 basis points. On our ETI associate investment, the turnaround in ETI's performance continued in 2023, and our associate income was up 77%, and this generated an HE of 1.2 billion rands. Excluding the reversal of the Ghana provision already referred to earlier, associate income was up 26% and resulted in headline earnings of around 1.1 billion. The return on original cost of the ETI investment was 22%. Looking more closely at our SADC operations, we're starting to see the benefits of a stronger foundation come through, as more of our business is increasingly aligned to the group and benefiting more from leveraging the enterprise capabilities. Some non-financial achievements included #1 in net promoter scores in 2 markets, namely Mozambique and Eswatini. And in 2023, we launched Avu Super Shop in Namibia, a first of its kind in that market, and has been received very well overall. Our digitally active clients now make up 64% of the base. In line with our strategy of strengthening our foundation, the journey to converge our technology infrastructure into the group's managed evolution platform that Mfundo spoke about is now firmly underway, and we should start to see a lot more activity across the markets we operate in as we work to offer our clients the same Nedbank banking experience across all our SADC subsidiaries. This convergence will also contribute significantly to continuous improvements in our control environment. With the weakening of the local currency and significant dollarization of the Zimbabwean economy, a larger portion of our major clients now borrow in USD. Therefore, our US dollar book has significantly increased with a CAGR of over 100% since 2022. Namibia continues to be the major contributor in our portfolio, holding 48% of total SADC assets. Turning to our ETI investment. On the graph on the bottom left-hand side of this slide, we can see that the ROI has increased towards our aspiration of consistently achieving ROI greater than 20%. On the graph on the right, our carrying value as at December 2023 was 1.3 billion against a market value of 2.2 billion at the same time. However, following the further recent Naira devaluation, the market value as of end of February 2024 declined to 1.5 billion, which is still 250 million higher than the carrying value as at end December 2023. ETI continues to be a strong franchise in West and Central Africa, and we've seen their share price increase by roughly 97% year on year. ETI return on tangible equity increased to 25.6% from 21%, with their 3 core regions, UMOA, AWA, and CISA, achieving ROEs above 28%. And finally, turning to the outlook for Africa regions. In 2024, we will continue to build on the improved performance in the SADC operations, and as a shareholder, continue to drive value unlock relating to our ETI investment. In the SADC operations, our key focus areas will continue to be executing on our technology convergence and harmonization journey, transforming the business and operating model to leverage group centers of excellence, and continue to grow our digital growth strategy, unlock further value in Mozambique, and in the medium to long term, we remain focused on achieving our ambition of consistently generating returns that are above cost of equity and a cost-to-income ratio of below 60%. Thank you, and back to you, Mike.
Thanks, Terence. In closing, as usual, I will provide our outlook for the period ahead, starting with our Group Economic Unit's latest economic forecasts, and then our 2024 targets or short-term guidance. I will also reflect on our medium and long-term targets, provide an update on the Chief Executive succession process, and then conclude with some closing remarks on our focus on shareholder value creation through delivery of our strategy. So starting with the latest macroeconomic outlook from Nedbank's Economic Unit, and this outlook informs our short and medium-term guidance to the market. We forecast South African GDP to increase in 2024 to 2026 by somewhere between 1 and 1.6%, as you can see on the slide, an improvement from the 0.5% in 2023, but still disappointingly low, given the slow progress on the structural constraints to higher levels of economic growth that are outlined earlier in the presentation. Average inflation is forecast to ease further and average 5% in 2024. However, upside risks to inflation do remain, including the threat posed by the conflict in the Middle East to global oil prices, a vulnerable rand sensitive to changes in US interest rate expectations, and further aggressive hikes in electricity tariffs and other administered prices. We currently expect the prime lending rate to ease from July and for interest rates to reduce cumulatively by 75 basis points this year, taking the prime lending rate to 11% by the end of 2024, and then a further 50 basis points reductions thereafter. Credit extension is forecast to slow in the first half of the year before gradually picking up to about 5% by year-end, supported by the anticipated decline in domestic interest rates and, of course, strong growth in renewable energy investments. Turning now to our usual format of line-by-line income statement guidance for the short term to the end of 2024. Net interest income, or NII growth, is expected to be above mid-single digits, driven by moderate advances growth and a net interest margin that is expected to decline slightly, mainly due to asset mix changes, as lower margin wholesale advances grow faster than higher margin retail advances. Given our interest rate forecast that I have just taken you through, average prime in 2024 is expected to be 11.5%, compared to average prime of 11.4% in 2023, and as a result, interest rate-related endowment benefits are expected to remain intact period on period. The credit loss ratio is expected to decline from the 109 basis points, back to within the group's through-the-cycle target range by the end of 2024, due to ongoing reductions in RBB's credit loss ratio and the resolution of material risks relating to CIB's non-performing loans having been completed in 2023. The credit loss ratio in the first half of 2024 is expected to be lower than it was in the first half of 2023, but is likely to still be just above the top end of the group's through-the-cycle target range, before reducing into this range in the second half of 2024 and over the full year. NIR, or non-interest revenue growth, is expected to be above mid-single digits as a result of main bank client gains, cross-sell benefits, and deal closures, as well as an improvement in trading revenue and insurance income. All of this partially offset by higher base effects from fair value and net monetary loss and FX gains. Our focus on tight expense management remains in place, and we expect growth of mid to upper single digits as we absorb new regulatory costs such as deposit insurance and an increase in the number of youth employment service opportunities that we provide. Underlying associate income from our share of ETI's earnings is expected to remain robust, but will be impacted by the non-recurrence of our 175 million rand Ghana bond provision that we released in the first half of 2023. Capital ratios are expected to remain well above board ranges, and our dividend, subject to board approval, declared at the top end of the payout ratio. While reaching our 2023 targets was an important milestone for Nedbank, we know that more needs to be done to continue to increase our ROE and, as a result, our price-to-book ratio to create shareholder value. Our focus, therefore, now shifts to our medium-term or 2025 targets, where we aim to deliver ongoing DHEPS growth of 5% above nominal GDP, improve our ROE to 17%, enabled by a lower cost-to-income ratio, and, of course, maintain our number one ranking among South African banks on client satisfaction metrics. In our booklet slides, we unpack the key drivers that we are focusing on to shift our ROE from the current 15.1% to the 17% medium-term target in 2025. The process to choose my successor has been well managed by the Nedbank board. On this slide, we show the key timeline since the appointment of Daniel Manelli as chairperson of the Nedbank Group, succeeding Mpho Makwana, to the start of the planned chief executive succession process in June, and then the announcement that we made in November last year regarding the appointment of Jason Quinn as CE designate. After completing his so-called gardening leave, Jason will start his employment at Nedbank on the 22nd of May as CE designate and will become chief executive when he joins the board at our AGM, which is currently scheduled for the 31st of May, and I will retire from the board as planned. I will be available for a further 3 months as a senior advisor to facilitate a seamless handover. I wish Jason all the best and know that Nedbankers will welcome him and that Nedbank will be in good hands with Jason leading a very strong Exco team. So in closing, while the external environment remains difficult, we do expect some improvement in the macroeconomic environment for banks and our clients into 2024, with risk to the downside possible from unforeseen geopolitical events. We have strong foundations in place, with an experienced board and leadership team, a strategy that is demonstrating improvements in growth, productivity, and returns, a track record of delivery, a world-class technology platform, a fortress balance sheet, and great people and culture at Nedbank that help us deliver on our purpose and lead in ESG. I trust it is evident to all of you from our presentation today that there is good momentum in the Nedbank business, whether from attractive lending pipelines, digital client and market share growth, cost optimization efforts, or the downward trending impairment profile. While we are pleased to have achieved all our 2023 targets in a difficult environment, our focus remains on ongoing improvements in our ROE from 15% towards our 17% target in 2025, to increase our price-to-book ratio, and as a result, to continue to create shareholder value. Thank you, and we will now proceed to Q&A.